Welcome to the deep dive. If you're invested in understanding the direction of global energy strategy, you know that 2026 is not shaping up to be a quiet year,
Not at all. I mean, it's really defining itself as a critical inflection point.
especially in the upstream sector, right? The exploration and production side of things.
Exactly. We've pulled together a stack of key industry reports, some research notes, financial outlooks, and they all point to the same core tension.
Yeah.
The industry is hitting record high production levels, which sounds great,
Uh,
but at the same time, it's under this persistent pressure from, uncertain pricing and pretty volatile global demand.
so our mission today is to cut through that noise. We're going to distill the major strategic pivots that are driving this whole transition.
Right. And it's not just about geology or trading futures.
No, it's a foundational shift. It feels like the industry is moving away from just chasing volume and more towards what the sources are calling operational excellence.
And value capture. We're really going to examine the specifics of that playbook, the disciplined spending, the tech requirements, and the reliance on these highly specialized support services that are helping operators pull off this delicate balancing act.
So what operational, geographical, and technological shifts should you be prepared for as we head into 2026? Let's unpack it.
Let's do it.
Okay, let's start with that macro picture because the sheer scale of the output right now completely reframes the whole strategic discussion.
It really does.
The U.S. It's riding an unprecedented wave of crude production. We looked at the data from the U.S. Energy Information Administration, the EIA.
And the numbers are staggering.
For September 2025, U.S. crude output surged to a record 13.84 million barrels per day. Just a stunning figure.
That is the headline number that dictates so much of the global market dynamic. And what's fascinating is where that strength is coming from.
It's not just one place.
No, it's not. It's coming from the continued, optimization of those massive onshore shale basins, but also combined with really robust, steady output from the Deepwater Gulf of Mexico.
But hold on. If output is at an all-time high, creating this flood of supply, doesn't that inherently put a ceiling on prices? That feels like a paradox.
It's absolutely a double-edged sword, and you hit the nail on the head. This huge output surge puts significant structural pressure on global supply balances.
So it's a buffer.
A massive buffer. It dilutes the power of organizations like OPEC to unilaterally control the market.
So the higher the U.S. output, the less flexibility those major producers have to raise prices without facing immediate competition.
Exactly. Which is why the sources call this a critical inflection point. Operators just, they can't afford inefficient operations anymore, hoping that higher prices will mask the waste.
That's the big strategic takeaway then. The market has signaled that abundance is here to stay, so financial discipline is now a requirement, not an option.
That's it.
And yet, despite all this volatility and the pricing pressure, we're not seeing the industry completely retreat.
No, not at all.
We're seeing a continued appetite for investment in new acreage, which suggests companies still see significant long-term value here.
Correct. And we're seeing a couple of key geographical trends that prove this. First, look at Australia.
Right. They're signaling strong government support.
They're opening new offshore and onshore petroleum exploration acreage in Victoria. It's a targeted effort to attract players into a basin that has been, traditionally underserved. It shows governments are serious about long-term resource security.
And, crucially, those high-stakes, long-cycle, deep-water plays haven't vanished. A recent major Gulf of Mexico lease sale drew really strong bids from the heavy hitters.
Big guys. BP, Chevron, Shell.
Yeah, all of them. And that level of spending, that signals a long-term commitment to deepwater, even with all the regulatory hurdles and the multi-year timelines.
And we're seeing this growth materialize through smart M&A as well. Take Cenovus Energy, for example.
After the mega acquisition.
Exactly. Following that deal, they're forecasting higher 2026 output. They're expecting to land somewhere near 945,000 to 985,000 barrels of oil equivalent per day.
And that's not just luck. That's growth driven by strategic consolidation.
Specifically in oil sands and offshore. So yes, the industry is still growing its capacity, but that growth now demands this foundational commitment to discipline.
Which leads us perfectly into the operational playbook for 2026. If output is high and price pressure is real, the tactic can't just be drill, baby, drill.
No, that era is over.
So what's the core mindset change the sources describe for this next stage?
The core change is a move from chasing absolute production volume to aggressive value capture. Our sources emphasize a pivot toward capital spending discipline
Kind of efficiency.
and intensive efficiency gains rather than just broad, expensive expansion. It's the only logical response to uncertain pricing, unpredictable demand, and all the cost pressures that come with abundant supply.
I'm trying to square this, though. If prices are low, shouldn't companies just be cutting back on everything, not just focusing on discipline? Why is 2026 the year this becomes so critical?
Because operational costs haven't stabilized. Efficiency gains have to counteract cost inflation. You're still dealing with supply chain bottlenecks, rising labor rates for skilled folks, more regulatory complexity.
I see.
If you want to increase your margin in a flat price environment, the only lever you can really pull is lowering your internal cost structure. That's the heart of capital discipline.
Okay, so let's give our listeners the concrete strategies. If you're an operator drafting that 2026 budget, what are the, say, 4 non-negotiable strategies you have to prioritize?
They're all looking for projects that are fundamentally resilient. So first, they have to target projects with the lowest break fens.
And just to clarify for everyone, what actually goes into reducing a break-even price in the upstream world?
It's primarily technical optimization. So that means reducing drilling time, maximizing the number of wells you can drill from a single pad, what they call pad drilling.
And enhanced recovery.
And crucially, smart deployment of enhanced recovery techniques. That's where you inject CO2 or water to boost output from existing wells, which lets you avoid the huge capital cost of a brand new field. Lowering the break-even means you make money even if oil drops significantly.
Got it. What are the other 3 priorities?
Second, maintaining tight cost control on drilling and completion. That's just essential. Every dollar saved is a margin gained. Third, they have to implement flexible budgeting.
So they can pivot quickly.
Exactly. They create scenarios where capital can be deployed or halted if market conditions change, instead of being locked into rigid multi-year plans. And fourth, they need to prioritize smart spending on high-return assets.
Proven basins where the geology is already well understood.
Right, or those enhanced recovery projects we just mentioned. Less spending on, expensive, wild, speculative plays in unexplored areas.
That playbook demands a high degree of financial agility, but focusing purely on the lowest break-even projects. It seems pragmatic short-term, but doesn't that mean sacrificing the long-cycle, high-reward frontier plays that you need for supply 5 or 10 years from now?
That's the tension, yeah. And sources address this. The idea is that firms that achieve capital discipline in their stable domestic production like in the U.S. shale basins are then financially strong enough to strategically blend those assets with global growth plays.
So they use the cash flow from the low-risk domestic stuff to fund measured bets in high-potential areas overseas.
Precisely. New offshore developments, frontier basins, projects with LNG export potential. It's like building an investment portfolio, You need the stable bonds and the high-risk, high-reward tech stocks, but you have to fund both responsibly.
It creates a diversified exposure. Resilience to short-term shocks, but with long-term growth potential.
That's the goal.
And that brings us to the non-geological drivers. This is where it gets really interesting, because 2026 investment decisions are weighing efficiency not just on price, but on, ESG. Environmental and governance performance. It's a dual mandate.
It really is. Technologies that can reduce costs, enhance automation, and critically reduce emissions, those get priority in these tight capital budgets. The decision criteria has evolved beyond just geology.
Because operators now get that these tech investments have a dual benefit. They lead to stronger financial returns, and they also improve resilience to the evolving regulatory landscape and all that ESG pressure.
It's about building a future-proof operation that shareholders will actually like. Think about fugitive methane emissions.
Okay.
Investing in better monitoring technology reduces waste, which saves them money, and at the same time, it reduces their carbon footprint, addressing stakeholder concerns. That's the kind of investment that gets greenlit now.
And this demand for hyper-efficiency is exactly why specialized firms are coming into the picture. We've seen sources referencing companies like EAG Inc., who provide expert guidance across the whole energy value chain.
Upstream, midstream, mining, even renewables. They exist to fill that immediate expertise gap that a lot of operators have.
Their whole goal is clear: help organizations automate and optimize, improve data reliability, and transform raw data, which the industry generates in staggering amounts, into actual, actionable information.
It's operational excellence delivered externally. because, frankly, many traditional operators just lack the internal IT resources to pull this off themselves.
That makes perfect sense. I mean, modernizing massive enterprise systems like implementing a new TIPS system, treasury, investment, and payment systems, that's incredibly complex.
It is. So external experts can accelerate that without pulling core staff away from field operations. These firms offer high-level consulting services for process optimization. They handle the complex technical side through IT outsourcing.
So optimizing legacy systems, getting them ready for AI integration.
Yes. And they also handle the administrative side, which, is a massive area for efficiency gains. They offer back-office outsourcing, so operators can rely on experienced experts to meet regulatory deadlines and get accurate financial reports out on time.
The sources specifically highlighted one cutting-edge solution being used, New Era Solutions. It sounds like the pinnacle of this whole efficiency mandate.
It really is. It's an AI-powered land management platform. And land management is one of the most detail-oriented, high-risk, and frankly complex parts of the upstream business.
Because of all the fractionalization of mineral rights and the sheer volume of contracts?
Exactly. So an AI solution can deliver substantial cost savings by achieving unparalleled accuracy and speed. AI can process and verify thousands of complex land contracts and lease agreements in minutes.
Finding inconsistencies or errors that would take a whole team of landmen weeks to find.
Right. Leveraging AI there drastically reduces administrative overhead, minimizes legal risk, and directly hits that efficiency mandate by optimizing the non-drilling side of the business.
And what's remarkable is the proven value here. The sources note that specialized firms like this bring, over 20 years of experience, completing over 100 engagements a year.
And have an exceptionally high client rehire rate, over 80%.
That statistic is crucial, isn't it? That level of reliance on external expertise confirms that this isn't some niche trend. Operational efficiency is now the bedrock of the sector.
It is. They aren't using these firms for side projects. They're relying on them for fundamental business execution.
Of course, implementing all these complex solutions, AI land management, a new TIPS system that requires a workforce that is constantly learning and adapting, which brings us to the human capital side.
That continuous learning is absolutely essential. The strategic shift toward complex data analysis and capital discipline demands a significantly more sophisticated workforce than even a decade ago.
The knowledge base for something like land management and division orders is just getting more and more complex, right?
Precisely. That complexity drives the need for targeted education. For anyone working as a lease and title analyst, for example, there's the NALTA Conference 2025.
That's August 4th to 6th in Miami. And it focuses on continuous education, from basic lease interpretation to advanced title review.
And for the critical financial support roles, the division order experts, there's the NATOA 2025 Institute. That's August 27th to 29th in Boston.
Right, that one's dedicated entirely to division order analysis, helping analysts understand ownership stakes, revenue distribution. I think the sources said they have sessions on using Excel for DOI builds and prep for the CDOA exam.
And finally, there's the vendor-specific education, which is crucial for maximizing the return on software investments. The Inertia User Conference is September 4th and 5th in Nashville. That's where customers get updates, hands-on sessions, and importantly, earn CPE credits.
Because if you don't fully understand your systems, you'll never achieve that required efficiency.
Yeah.
So wrapping this all up, what does this entire stack of sources mean for the upstream sector heading into 2026? The central takeaway seems crystal clear. The sector demands agility.
And the winners won't be defined just by how much they can produce,
but by how disciplined, how technologically integrated, and, how administratively flawless they are.
The playbook is meticulous. It's about ruthlessly optimizing every variable you can control. Prioritize those low break-in projects, maintain capital discipline.
Strategically look overseas for diversified growth.
And, critically, leverage technology and automation like AI-powered solutions like New Era to achieve that unparalleled accuracy and cost efficiency in areas that used to be massive administrative burdens.
The era of easy growth is over. This is the era of optimized growth. We've seen that the energy sector is moving away from simply maximizing volume toward maximizing efficiency and value in every single process.
From the back office to the drilling rig, which raises an important question for you, the learner. If this hyper-focus on optimizing every process, leveraging AI for specialized tasks, and maintaining ruthless capital discipline defines success in an industry as complex as upstream energy, how could applying that same efficiency over volume strategy change the way you approach your next major professional or personal project?
Something to mull over until our next deep dive.